Кажам нешто на микрофончево да видите дали се добива линиски, така чак да взимаш тест, 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 тест. На Vienna, Vienna, тројка англиски. Тест, 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 тест. Добро. Тест, 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 окей. Тест, 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 тест.
Ladies and gentlemen, please take your seats. Good morning, ladies and gentlemen. Welcome to the annual Vienna Initiative Forum. This year, the National Bank of the Republic of North Macedonia has the privilege to host the forum. At the beginning, it's my honor to invite the Governor Anita Angelovska-Bežovska to give welcoming remarks. Governor, the floor is yours.
Good morning, dear colleagues, Your Excellencies, Ambassadors, Minister of Finance, dear governors, Chair of the Vienna Initiative, Governor Vujicic, distinguished representatives of the European and international institutions, dear ladies and gentlemen. It's my great honor and pleasure to welcome you at the annual full forum meeting of the Vienna Initiative. As Helen Keller said, alone, we can do so little, but together, we can do so much. This saying lies in the essence of the Vienna Initiative, a partnership among public and private stakeholders whose common objective is safeguarding the financial stability in the CEC region. Established at the height of the global financial crisis, to prevent nation-based uncoordinated policies that could lead to systemic banking crisis, we have come a long way, expanding our activities and fostering financial stability in the region. This initiative is particularly relevant for countries that still do not belong to the European Union family, do not have access to the European backstop facilities, and as such, are even more vulnerable to exogenous shocks. Collaboration and coordination is key in times of crisis. Unfortunately, in the last 3 years, we are in the mode of perpetual crisis. Severe global shocks of unprecedented nature are hitting the world economy and unfolding into the great return of inflation and cost of living crisis. This implies abrupt change of the environment in which central banks operate. From more than a decade of extremely accommodative monetary policy to deal with the low prices puzzle, all of a sudden we have to shift gears to deal with the multi-decade high inflation. Last year, world inflation accelerated close to 9%, which is more than twice as high as the average than the previous 2 decades. CEC economies are not an exception. Last year, inflation abruptly accelerated, reaching 13.3%. Even more so, we are not dealing with a conventional demand shock that drives the surge of prices, not only with us, but rather with multiple shocks. Although some empirical studies are emerging, precise disentangling of supply versus demand, external versus domestic, transitory versus permanent drivers, at least at this point, seems challenging. However, what seems clear is that we are seeing faster and stronger pass-through of these shocks into the prices. In the past, pass-through of producer to consumer prices typically took about 2 years, while now, according to the recent ECB study, it is much faster, broadly about half a year, and it's also more intensive. as firms maintain and in some sectors even increase the profit margins. Upward inflationary risks are amplified by the structural forces in place, such as geopolitical tensions and risks of economic fragmentation. A BlackRock study on 68 risk events since 1962 indicates that the geopolitical tensions typically have had a short-lived impact on markets and economies. But this time seems different. Current developments pose one of the greatest stress tests to the globalization that, in the last 4 decades, through trade, financial and technological integration, brought many benefits, including market decline of the global inflation. The cost of deglobalized world can be severe: lower efficiency, higher costs, and stronger and more persistent inflationary effects. Against this background, central banks need to be more humble. They cannot prevent the first-round effects of many of these shocks, but containing the second-round effects and anchoring inflationary expectations has to be the focal point. This context prompted central banks to embark on the most synchronized and rapid monetary tightening in the last 15 years. As interest rates hikes are taking hold, with easing supply pressures and stabilizing commodity prices, forecasts indicate that inflation will soften this year, both in advanced and in developing economies. And indeed, we already see some signs of slowdown, but it is too early to claim the victory over inflation. Core inflation in many countries remains persistent, with tight labor markets keeping pressure on wages. Nominal wage growth in the region last year was the highest following the global financial crisis, 8.6%, at 8.6%, notably exceeding the productivity gain of 2.3%, thus contributing to the rise of core inflation. If this wide wage productivity gap persists, it can slow down inflation stabilization process and require a longer and stronger monetary policy reaction. On the other hand, the monetary tightening, that is the transition towards an environment of higher interest rates, could certainly expose some vulnerabilities of the financial systems and again test their resilience, as the pandemics in fact did. The pace of financial tightening matters in particular, as history shows that the effects are better manageable if tightening is gradual and well-guided. The last year financial market turmoil in UK and the recent developments in US and EU clearly underline the need for vigilance. This nexus opens the so-called financial dominance dilemma of the so-called financial dominance, that is the possible trade-off between rising costs to curb inflation and effects for financial stability. Against this background, one of the key questions is how well are financial systems prepared to rise to the challenge of the rising interest rates? The answer to great extent boils down to the health of the balance sheets of the households, companies, and banking system, that is, their capacity to absorb the shocks. What is very important is that the banking systems in the region weathered the pandemic shock well, and in many countries, including in our country, emerged with even stronger capacity, which can be observed by higher capital and liquidity buffers and better quality of the credit portfolio. Although according to the recent EI-based surveys, banks expected deterioration of the credit quality, NPL ratio so far has remained low, below 4%. Still, given the elevated debt levels of the private sector, that in the region hovers around 80% of GDP, increase in the real estate prices, which in the CEC region reached 15.5%, the highest growth since the global financial crisis, as well as expected further tightening of the credit conditions. Definitely, it's not a time for complacency. One of the key lessons learned from the COVID-19 crisis is the resilience, and it must remain the name of the game for the banking sector going forward. In the current context, when the interplay between the monetary policy and the financial stability is more complex and trade-offs are larger, macroprudential management plays an important role. A recent BIS paper finds that prudential policy tightening ahead or during the monetary policy tightening reduces the likelihood of financial stress and provides more headroom for the monetary policy. Following the pandemics, counter-cyclical or systemic risk capital buffers were actively deployed across the region. Financial regulators in 7 countries, including in our case, intervened with a counter-cyclical capital buffer. In 6 countries have continued to apply or introduced for the first time systemic risk buffer. And in 5 countries, borrower-based measures were implemented as measures which more directly affect the quality of the credit demand and contain risk. Keeping banking sector sound and in good capacity to lend is also important in light of the urgently needed structural reforms in the region. As we are lagging behind advanced Europe in terms of the productivity and income, sustaining banks' financing can contribute in narrowing those gaps. At the same time, climate change and technological innovation continues to accelerate, pressing on our societies to transform towards greener and digital future. And banks can definitely play a crucial role in financing this twin transition. To sum up, as policymakers, we do face a difficult conundrum. After a long time of economic moderation, all of a sudden, we have to deal with major global shocks that impose tectonic shifts in the economic order, modify conventional macroeconomic paradigms, and accentuate the trade-offs in policymaking. In this current context, it is crucial to preserve stability of the prices as our primary objective, and contribute to stability of the financial system. We all recall how profound consequences and scarce instability can cause, which is why we have to remain determined, focused, and clear. It is the only way to preserve public trust. And as Brunner Meyer said, the public is the ultimate source of central bank power and independence. Thank you very much, and looking forward to the insightful debate.
Thank you, Anita. Dear guests, as the chair of Vienna Initiative, it is my great pleasure to welcome you all to this 2023 edition of our traditional full forum of the Vienna Initiative. I'd like to start first with thanking to our hosts, National Bank of Macedonia. Thank you very much for organizing it. You know, many of you know that we were supposed to have a full forum in Ukraine last year. So this is the 15th year of the Vienna Initiative, and 14th edition was supposed to be in Kiev. Unfortunately, the Russian aggression on Ukraine has, I would say, not cancelled it, but postponed it, because I'm sure that we're going to go back to Ukraine as soon as possible once the things calm down there, and we will have a Vienna Initiative Full Forum in Ukraine in a due time. As you know, the Vienna Initiative is mostly about international cooperation. It emerged in 2009 on the basis of the cooperation between the IFIs, regulators, and the banks. And today, the importance of facilitating dialogue between market participants has been almost as critical as it was when we emerged. The financial sector, as we have witnessed in recent days, faces compounded challenges, which makes it difficult to read signals and interpret data. What we should do, we should encourage information sharing across multiple nexuses of the financial sector, and this is what we will try to do. First, the public authorities must provide private agents with clear guidelines on objectives to limit regulatory complexity. This is something that we were trying to do in the past. And private agents on the other side must diligently share clear data and information with the regulator to create conditions for fair and optimal decision-making. The cross-border exchange of information, which lies in the Vienna Initiative's DNA, will again play a key part in building up financial resilience in the region and, in wider terms, in the whole financial sector. Clear overview of intra-group strategies and status are crucial to detect early signs of distress and act swiftly. We have been witnessing these days how important the transparency of the data sharing, understanding the exposures on a cross-border basis is. Many of us were scratching our heads over the last couple of weeks trying to understand the complexities of the interrelationships, both across the Atlantic and particularly within Europe in the last days. Third and last, in the institutional nexus, as national, supranational authorities must work together to leave no weak links and continue our harmonization efforts. We will cover a number of these key challenges in the sessions in the next 2 days. The aftermath of the COVID-19, which most of us expected to result in the materialization of credit risk in the beginning, we didn't see that much of NPLs because of the huge effort by the both fiscal and monetary policy to shore up the economies during the COVID-19. But I would say that it's still unclear whether we will see increase in the NPLs in the next period, particularly as the recent turmoil in the banking sector shows, and the end of cheap and abundant liquidity ends, as it is at the moment. Liquidity and market risk seems to have returned to the top of priorities of risk managers, in the case they are in banks. Some banks didn't have them for some time, and of course us supervisors. Over the course of this forum, we will have the chance to discuss these challenges for banking sector in session 4. Although most of the public attention lies on salient issues in the news, we should also not underestimate the potential resurgence, as I said, of the credit risk in the context of the higher costs of funding, and early signs of asset quality deterioration will be addressed in our sessions 3 and 5. Of course, war in Ukraine remains a focal point for all of us, and it would be challenging to discuss financial stability in the Vienna Initiative region and not mention the Russian aggression on Ukraine's territory and population. Aside the destructive and life-taking nature of the conflict, consequences on the economy and the financial sector are no less dramatic. Our guest of honor, the NBU's first Deputy Governor Katerina Roshkova, will share insights on how the central bank managed to keep the banks operational and to build an economy compatible with war effort in the second session after our first panel. If the first day of the full forum will focus mainly on upcoming challenges, this edition will also provide some insights on how to leverage opportunities in the banking sector. On the second day, we will discuss necessary transformations to our financial systems. As the pressure from authorities and investors pushes banking groups to accelerate their transition towards a greener future, as you know, we have a dedicated working group to the climate change, and we will be able to hear on the progress made by that working group. Before final remarks and conclusion, we will also reflect on the evolution of financial services and how to balance efficiency gains resulting from digitalization with the potential instability it carries. I think it will be also interesting for Vienna Initiative in the future to reflect on the consequences of the central bank digital currencies on the region. The fact is that it's only the large central banks that are now planning to introduce the digital currencies, but the introduction of digital currencies will certainly have an effect on everybody else, even those that do not issue digital central bank money. And few words on the housekeeping. Before kickoff, I would like to remind you that aside from the first session, all discussions, as usual, are organized under strict respect of Chatham House rules. So the first panel will be with the presence of the media. Later, the media will leave, and participants may freely use the information received during the sessions, but neither the identity nor the affiliation of the speaker nor that of any other participant may be revealed. And I will conclude this introductory statement by thanking all attendees to this forum again for your commitment to multilateralism and constructive dialogue. My gratitude also goes to our distinguished speakers and panelists for agreeing to share their perspectives and shed some light on current developments. And with that, I will invite the first panel to come to the stage, and we can start. Please. Okay, for the first panel, we have four policymakers and vice president of the IFI. So let me start from my left-hand side with Anita Bezhovska, who you already heard. She's the governor of the Central Bank of Macedonia. Then my friend and colleague from the ECB Governing Council, Peter Kažimir, a governor of the National Bank of Slovakia, also former Minister of Finance of Slovakia. Then Radoje Žugić, my good all-time friend, who is the governor of the Central Bank of Montenegro. Fatma Vesimi, who is the Minister of Finance of Macedonia, so he will shed some light on the fiscal policies. And finally, last but not least, Liliana Petrova, who is Vice President of the European Investment Bank, and will give us a little bit of insight of how the people in the EIB see the current juncture of the development in the financial system when the interest rates and the cost of borrowing are finally increasing after a long time. So basically we are here with small open economies which are facing, like everyone else, the period of the increased inflation rate in countries that are present at the panel are approximately between 12 and 14%, which is significantly higher than the historical average over the last 10, 15 years of 1 to 3%. Of course, the reasons why we saw the surge in inflation are same like elsewhere in the world. The post-COVID recovery in all these countries, ministries of finance have also helped a lot the economies during the COVID crisis. Then the rapid recovery of the economy after the crisis brought about inflationary pressures already in 2021. And then in 2022, with the Russian aggression on Ukraine, another supply-side shock, energy prices, food prices went up, which fueled the inflation further. And now we are already getting into a situation where the inflation might have peaked or has peaked, headline inflation, but the core inflation remains relatively stubborn. We know that the monetary policy is much better equipped to deal with the core inflation because it's typically demand-driven than with the supply-side shocks, which might be transitory. And we will now like to hear from the panel how do they see the current situation and developments further down the road. So let me start with Anita and ask you, Anita, what is your assessment of the relevance of the supply versus demand and domestic versus foreign shocks as drivers of inflation in Macedonia, and how much of the maneuver room you think the monetary policy of the small open economy in these circumstances, this context of the mixture of these shocks has in order to fight the inflation?
Thank you, Boris, for the question. Very relevant question. I think in this multi-decade high inflationary environment, it doesn't come as a surprise that one of the key questions that has been discussed widely in policy by policymakers and academia are the sources of inflation. To what extent it is supply, demand, and so on. Why it is important, of course, because based proper diagnostics of the sources is key in adequate calibrating of the policies. If it is more demand-driven, then it calls for more aggressive tightening of the policies. If not, then requires a more carefully designed mix of policies and will include more difficult trade-offs. I think it's, despite the fact that we have faced in the last couple of years of repeated and unprecedented supply shocks, which definitely pushed the inflation, cost inflation, resulting in cost of living crisis, but still overall there is no, even in a broader general context, global context, clear consensus on the relative contribution of supply versus demand or external versus internal. Of course, we are seeing some paper emerging. For example, recent BIS paper looking at the inflation in EU and US, which finds a mix of factors that affect, though for US, higher contribution of demand, which is consistent with the stronger recovery underpinned by the stronger fiscal impulse in comparison with the EU, which is also clearly visible through the output gap, which is positive in US, in EU, still negative, and differences in tightness of the labor markets that are also playing in recent period key role. In case of North Macedonia, and probably similar in many other countries with a similar structure, highly open economy, and having in mind the cycle, position of the cycle that we have a relatively slow recovery, still negative output gap since 2020, I would say that predominantly major role has been played by external supply shock, but they have been propagated with very strong intensity, significantly stronger in comparison, for example, with the EU, which has been due to domestic factors. These are structural, but also institutional factors. In terms of the structural factors, we are one of the most open economies in the Central and Southeastern Europe, fifth in terms of openness, 140% openness, and our estimate of the central bank point that domestic inflation is on components with low import component account only about 11% in the total CPI, which is completely different if we compare with the EU, where it's about more than 30%. We're particularly vulnerable in the food and energy segment, which, by the way, account 51% of our CPI, which is completely different in comparison with the EU, which is about 30%. So it's no wonder that inflation, 3/4 of the inflation in our case are driven by food and energy, direct effect. We should also not forget that energy specifically have indirect effect because we are very energy non-efficient economy. We spend 3 times more energy per unit of GDP in comparison with the EU, which means that these commodity shocks affects many items, including the core inflation.
Practically, in a nutshell, these structural features of the domestic economy point that the same global shocks are propagated with a stronger intensity based on the domestic structural features. But the story doesn't end only with the structural features. There are also other factors: level of competition of domestic market, types of the policies that we have undertaken, which are, government policies to mitigate this external shock, which in our case has been mixed, but predominantly also, I would say, ex post, focused on dealing with the most vulnerable groups. And on the other hand, there are studies emerging that countries with a more broad-based measure had lower inflation. And last but not least, inflation has been more persistent, more broad-based. It has affected inflationary expectations, as in many other economies. It has pushed demand for increase of wages. De facto, we have seen acceleration of the wage increases that have reached, on average, last year 11%, somewhat above the average for the CEC, which is something that asks for close vigilance, especially in countries such as ours, when productivity is stagnating. So that's one area which definitely requires attention. Overall, I think even more important.
Just a second. Did you see can you tell what happened with the profit margins of the companies? Because we have this discussion now within the euro area, how much is the wage pressures, how much actually profits which have increased of the companies contribute to the inflation?
Yes, we have not precise analysis to make a clear point on this, but some anecdotal and partial data, I would say, point that there are sectors where the profit margins have increased. I don't want to generalize, and of course, before having precise analysis, it's difficult to draw conclusions, but there are signs, and I mentioned a recent study of the ECB, practically de facto points to this inference.
Okay.
Overall, I think what is important even more is that central banks, regardless of the fact that this is not classical demand shock that we have started early on tightening. We as a central bank started tightening in 2021, first with liquidity, foreign exchange operations. We use a couple of instruments. And very importantly, this synchronized cycle, as we are seeing globally, de facto reinforces the measures that we are undertaking. And this synchronized cycle, I think, definitely points that central banks will not repeat the same mistakes as in 70s, where inflation remained high for a whole decade, among other things, I think because of the misperceptions, at least partially, of the sources that are driving inflation.
That sounds good. Thank you. Peter, we've seen the increase in the real estate prices across the board in almost all countries prior to the start of the tightening of the interest rates. But Slovakia has been the champion. You've seen the highest increase in the prices of the real estate. So let me ask you, how important do you see the real estate market for the transmission of monetary policy on one hand? On the other hand, do you see some risks arising from the households overstretch related to the mortgages? So one aspect from the monetary policy side, the other one from the financial stability side.
Thank you, and good morning, everyone. First of all, I would like to thank to Boris and Anita for having me here, because this is the first time I'm here in Northern Macedonia, and this is the first time I'm on the event of Joint Vienna Initiative. So I have to appreciate this initiative and this opportunity to exchange the views. But back to the real estate, that's true that real estate is the main asset most Slovak households hold. And historically, the impact of monetary policy on the real estate was very limited. But it's true that this is changing profusely, and it's changing with the rapid increase in the household indebtedness, and how this importance of mortgage interest payments is raising in households' budgets, and how it is connected, channeled to the households' consumption. the current tightening of monetary stance will likely profoundly impact house prices and housing investment. Back in my country, both could be down as much as 10%. 10% relative to the scenario without tightening. It's true, and we are still working on isolating these effects of this particular channel, but it's gaining real significance. But just to explain more background about the reality in my country, Slovakia is the European Union country with the second most significant share of citizens desiring to own a residential property. So definitely the Slovaks, they prefer ownership before the rental. And if you combine this fact with non-functioning rental housing market, then you fully understand these drivers of this situation. So in my view, really developing of liquid rental housing market would be remedy, how to deal with, how to face the situation. On the risks, they are real, so especially to the financial stability, this is our role. So this is an essential topic for us because, as you probably heard, households in Slovakia have almost doubled their indebtedness in the past decade, and this is also, we are also champions in Europe again on that, unfortunately, and we were forced as a central bank to be very focused on macroprudential policy, and we became the laboratory of macroprudential policy toolkit, and we did everything what you can imagine.
Yep.
And
LTVs, DSTIs.
LTVs, DSTIs, everything, you know, so all these exercises. And our task was not easy, just to prepare households and banks for scenarios we currently face and we were facing in the pandemic. During the pandemic, we were quite successful, I think, with these moratoria issues, and together with ministers of finance, I think that was everywhere in Europe, luckily. But when we are talking about a specific approach, for example, we imposed several buffers on households, and one of them was related to the rising interest rates. I mean, that every new loan was tested for the rise of interest, of additional rise of interest rate by 200 basis points. So, for example, given current circumstances, you know, this mortgage interest rates really jumped. That was a rocketing from 1% on average to 4%. So this test is going to up to 6%.
Okay.
I must say that still we see that our households are able to manage this spike. And the reasons for this optimism is, I think, it's in fixation, because a fixation of interest rate on average is in my country 5 years only, was in the past, but in last year, the clients really, the new wave of fixation came, and it's also increased to 10 years.
And what's the percentage of the loans that have a fixed interest rate versus the variable?
Oh, that's 60%, you know. So this fixation, it's quite a current approach on the market. No, so now that means that the shock will gradually come up in households in 2024 and 2026. So in the future, in our view, households have enough time to prepare for this shock. We also do count with indexation of wages. In wage bargaining, this is the other side of the coin, which is also, I think, the risk to the monetary policy, but that's reality. And we have also relatively robust labor market with scarcity of labor force, you know. So that's behind this story. Our analysis confirmed this story. I think recently we conduct a relatively detailed stress test on individual households to understand the sensitivity of households to different shocks. And what we see that there, we do not expect any significant shock on quality of portfolios in banks. NPL is below 2%, you know, it's 1.8 on the retail, so slightly can be increased, but it's not nothing dramatic. And of course, there will be also the losers. That's alive. Certain groups, low income, and with high indebtedness. But the share of these households in bank portfolios is relatively low. And finally, still, it can be the paradox, but tightening era can be also helpful a little bit to the financial stability, because in our experience is that today the people take mortgages with much more prudence than it was just 1 year ago.
Yep.
So during the second half of last year, for example, the share of a household debt to their disposable income even fell, and that was the first time in our history.
Okay. People learn when they are allowed to learn. Okay, thank you very much. Rade, of course you're a currency board, and then within the currency board the most important instrument of the monetary policy is required reserve requirement, as you know. You don't have a huge toolbox, but you use the required reserve requirement at the beginning of the pandemic. You reduced it. Now you're also faced with high inflation pressures. How do you see it? You think it could be a useful instrument? Do you plan to increase it? Tell us, how do you think about it?
Good morning, dear friends. I would like to answer to two questions from Damjan Vojčić, but also including briefly some of the other elements with the greatest influence, spillover effects on the inflation and poor macroeconomic environment. All small countries, such as in Montenegro and others in the region, are sensitive to external shocks. That is the risk coming from neighboring country. Furthermore, its inadequate structure and the lack of diversification within Montenegro's economy further intensify its vulnerability. The key challenge almost all global economies are currently facing relate to high rate of inflation, resulting from a number of atypical inflation generators. These include long-standing expensive monetary policies, the impact of pandemic, and the policy of lockdown, surging aggregate demand due to a rapid economic recovery, and then war in Ukraine, which among the other things has endangered global supply chains in the context of high level of demand. In addition to inflation, Montenegro's economy is also facing a set of other challenges: an unfavorable macroeconomic environment, inadequate structure, and a great dependency of prevailing weather conditions, as well as weakened level of liquidity and competitiveness, along with a worryingly high level of public debt, an issue further complicated by the recent increases in interest rates. Inflation remained high in a large number of countries. In December of last year, it stood 6.5% in the USA and 10.4% in the EU. Across the region, it is being measured in two-digit numbers. The same goes for Montenegro, where inflation rose to 17.2% in December 2022, recording the highest values in the last 20 years since introduction of the euro, or since our country became independency. In the same period, the highest annual inflation among the EU countries was recorded in Hungary, also in North Macedonia. In Montenegro, inflation is mainly imported. That is, for the most part, it is determined by the growth of prices, imported food and energy-generating products. Montenegro's inflation has also been partially induced by internal factors, primarily inadequate structure of the economy and its poor competitiveness in the real economy, expressed through a negative balance of payments, which amounted to nearly 480 million euros at the end of September 2022. The negative balance of payments recorded a year-on-year increase of 90%. It is being covered by surplus recorded in tourism, remittance, and foreign direct investments. The second, internal factors. It is the first question from Governor Vojčić. I would especially special attention in this question. Influencing the country's inflation relates to the recent increases in salaries, which was not accompanied by any growth in productivity or the creation of new value. This has pushed up the level of demand, not only for products and services, but also for loans, which in the short term can be said to increase the tax basis. But, however, from the perspective of the medium term, it will become a significant fiscal problem because it will be widen the budget deficit and increase the cost of funding it. In the context, any further announcement of increase in wages would be very challenging. Now, increase in salaries produce increase in public debt, funding from public debt, and additionally undermine fiscal problem, high level and negative dynamic of public debt. The third factor of inflation may be linked to the increase in social spending, which wasn't preceded by an in-depth analysis of the real needs, nor the necessary analysis of the fiscal implication that it may produce. Curbing inflation requires coordinated action by both governments and central banks, that is a combination of fiscal and monetary policy measures. Reducing the rate of inflation to the desired level of 2%, which is the objective of all central banks, would halt the inflation spiral and reverse its adverse effect on economy. When it comes to Montenegro, the room for fiscal policy measures is rather limited. The level of public debt is worrying, as is the fact of its servicing will become more difficult in the upcoming years. This is due to the tightened lending conditions reflected in the strong growth in Euribor, resulting from the normalization of monetary policy aimed at containing the high rates of inflation. Increased interest rates put more burden on debt servicing, making the already precarious financial standing of households and businesses more challenging, which may lead to insolvency issues and dramatically slow the speed of economic growth. On the other hand, the central bank, due to our euroized economy, has limited monetary policy instruments. It was your second question, dear friend, available for curbing inflation. Our institution mainly uses the reserve requirement policy in the function of preserving financial stability, which is the reserve requirement rate is still a higher level than in the rest of Eurozone. It represents a liquidity buffer that can be lowered in the event of threat to financial stability and therefore provide additional liquid funds to the banking system in the short term. This is exactly what we did during the corona pandemic in May 2020, when we lowered the required reserve ratio by 2 percentage points and provided the banks with an additional 70 million euros. In this period, Central Bank prepared 12 packages of measures giving support to the citizens, companies, and also to the banks by new liquidity, cutting 2 percentage points of this instrument. We are carefully monitoring the situation, and depending on the overall health of the banking system and the ongoing process of European integration, we will make any required changes to the reserve requirement policy.
Okay, so you might raise it in the end. Okay. Okay. Fatmir, moving to the fiscal policy, of course, during the pandemic and then the energy crisis that we saw after the Russian aggression on Ukraine, governments did a lot in terms of the fiscal support for the households and the companies. But how do you see the situation now? Do you see further or additional fiscal support? How long you plan to keep it in place? And as every central banker would ask you, do you have in mind the inflationary impact of the fiscal policy if it stays there for a long period of time, if it's not really a temporary fiscal boost?
Yeah. Thank you very much. First of all, let me congratulate Central Bank Governor Anita for inviting all of you and holding this Vienna initiative in Skopje. In terms of the panel discussion and the question you raised, putting the fiscal aspect in this panel, how do we see this in this critical period? It's harmonization or coordination, better saying, is between monetary and fiscal policy in achieving our goal to stabilize, actually to respond to the crisis, but also to trace the medium and long-term sustainable growth and policy making. In this respect, the crisis which is coming, actually, we have a multiple crisis period, which is since the COVID time, we were saying that this is new normality, and we are living this new normality. In terms of fiscal, what happened in 2020, actually the financial markets were available with relatively good pricing in terms of the financing, and what happened in 2020, it was immediate response in the international community compared to IFIs, I'm talking, compared to 27, 29. This helped at that time to absorb the shock from COVID, which was non-economic shock, but de facto we had available funds. Our country increased the public debt on 10% of GDP, which happened in other countries in Europe. Some of them went beyond 20% of GDP as percentage points. The point I want to make here that at that time we ended up with 8.2% budget deficits. We had a very generous financing. I remember we had several meetings in the government. It was all the stakeholders, business community. At that time it was saying, you know, it's not a matter of price of money, it's a matter to finance this crisis, to absorb all the shock. And the perspective changed. A year after, we have, and you know, economic theory also that time was, and the policy makers were very, you know, the debate was whether this injection of money will create inflation or the economic growth and technological development will just push further growth. It was 2 years ago. We see what we couldn't foresee at that time was the invasion of Putin to Ukraine, and also what already was going on with the energy pricing, and the value chain, the global value chain was getting lower to recover than we expected. And actually the money that was available was, because of these cut value chains, didn't respond so fast. So we faced this with the prices in the fiscal, and the prices in financial markets that affected fiscal policies in general, but also in our country. So from this crisis, we still needed support because we had vulnerable categories of citizens, households, and businesses that face another crisis, shock on the supply side, from electricity prices, fuel prices, and of course, as a result, coming also the price of labor, the wages. And now the fiscal policy has another challenge. The financial markets now are tight and they are expensive. And we have to reduce the fiscal balance, actually the budget deficits, in the period when you need additional subsidies in the economy. So what was the strategy this time is that we continue fighting. We must give consistent policy messages to the stakeholders, I mean to the business community, because it matters their investments, it matters also other aspects on the making business and creating future growth, what we are expecting. And we moved also on transition of fiscal policies and support on this crisis of energy and inflation prices. And this is moving to more targeted, transition-based, which means also market-oriented, but to phase out in mid-term period of time. So this will help us fiscal consolidation, which reducing the budget deficits from 8.2 in 2020, in our case, to 5.4 in 21, planned for 5.1 22, but we ended up with 4.3 budget deficit as a share of GDP. And now we are projecting for next year, for this year, 4.6% of GDP deficit. And this deficit, if you see on the quality, what is the structure of this deficit, 1.5% of 4.6 budget deficit is buffer using for energy crisis. And out of this, 3.1% is in the budget structure where we have 5.3% capital expenditures. So trying to move towards more capital expenditures and budgets, supporting growth and investment. Because the time is I just noticed it's more than 5 minutes, what we agreed. I just want to put here now in terms of the this year and the following year is to give clear message on fiscal consolidation. We continue in our 5-year plan to have further reduction of budget deficits to 3% and also public debt on 60%, which is a big challenge at this period. But this de facto comes back to what I said at the beginning, coordination between monetary and fiscal policies, so we can create a space for monetary policy to go more moderately in terms of response to with interest rates, which at the end of the day reflects economic growth. So probably later on we'll come with other aspects. So thank you.
Okay. Liliana, we are now in the times of rising borrowing costs. Normal times, let's call them that way. Interest rates are high, and the IFIs have been complaining to me that, you know, with the low interest rates that the central banks kept for a long period of time, you often lost your business to the commercial banks because, you know, the interest rates were zero. So as a concessional lender, what are you doing? And I've heard it from the EIB, I've heard it from the EBRD. Now we're getting back to, you know, normal times. So how do you see the situation in the markets? Do you see an increased demand for concessional lending, and how do you see it evolving in the future? Do you have enough firepower to meet the demand further down the road?
Thank you very much, Boris. Let me first start with really expressing my warm thanks to Anita, to the governor, and to the whole team of the National Bank of North Macedonia for your warm hospitality as always and excellent organization of the full forum of a Vienna initiative, a very important platform. And I believe this day's event, is very timely, very topical, a period when indeed such a discussion is extremely important for all of us. And maybe the short answer, Boris, to your question is definitely yes, there is an increase of demand. There is definitely changing environment. However, and we do have the necessary toolkit, if I may say, to address such a demand. But of course, there are certain elements which needs to be considered carefully. But maybe let me start with more global context. As most of you already mentioned, apparently the inflation will stay longer. So, and we are kind of in a situation when the fiscal policy kind of remains rather accommodative. So, but nevertheless, I think the things are moving forward, are changing. Last week, the finance ministers in the format of ECOFIN discussed the Commission's proposal to reform the EU fiscal and governance framework. So I think it's becoming clear now that we are more closer to a more, targeted regime where sustainable investment will be extremely important, and it will be the new strategic link with what we previously called the Stability and Growth Pact. What we can see as a result of these turbulent times and different shocks, the banks are tightening the credit standards, but the credit demand of, especially of corporates and SMEs for working capital remains strong, especially in the CEC region. And this is what we also see as a result of our annual survey of the CEC region. So sustainable investment spending will be key engine of growth, and this is exactly what we are looking at the EIB, is really to see where public and private sector is having difficulties to address the needs, and what are the niche financing which we can stimulate. And speaking on the private sector, I should say that the result of our survey last year was looking specifically again in the impediments to invest, and the results are very, very clear. 87% of companies, of firms, are outlining 3 key impediments for long-term financing: uncertainty, lack of skilled labor force, and high energy prices. And this is almost 87% of the companies. So this is exactly what we need to address: investing skills, digital transformation, technologies, automation, reskilling, and of course investment, smart, digital, and sustainable investments in renewables, etc., etc. And I should say the uncertainty is the new certainty. This is what we conclude nowadays. So we need to be able to be flexible, to be agile, to address the needs. So I could say that the current environment with the increased interest rates is definitely providing more demand for our standard products. Our AAA rating provides for more advantages to be transferred to our clients and to our partners and promoters. But of course, we are not looking only in the quantity. What we look especially and focused on is the quality of the investments, because we need to be mindful of our alignment with the EU priorities and with our, as we call them, transversal objectives, which are 2. We have, in fact, 2 transversal objectives of our financing: climate and cohesion. Because climate and now the decarbonization is more important than ever. I don't need to say any argument in that direction. And our commitment is to mobilize €1 trillion of climate and sustainable investment by the end of by 2030. But at the same time, ensuring that specifically CEC region, cohesion region, is receiving this more tailor-made specific support to ensure that just and fair transition is in place, because we need to really invest smartly. So the things are not so simple. We need to be ready and prepared to address any new shocks coming, because we see them coming one after another. And we are also focusing more from that perspective to address this high impact and more riskier financing, because this is the niche which needs to be filled. Like back in 2008, we were first to issue the green bond. We then started financing offshore wind power in many others, and 20 years ago, commercial banks were not willing to engage, which is definitely not the case today. So today we are doing the same. We are financing this type of floating offshore wind, hopefully here also in North Macedonia as well, soon battery storages, green hydrogen, and this is a niche again we need to boost the investments in order then for the market, for commercial sector to be there. So this is more or less how I can see. Demand is there, but high quality and long-term sustainable investments are key.
Okay, thank you, Liliana. As I have said before the panel, when you told me that 5 minutes is enough to answer the question, I told you it's not going to be enough. You'll see once all of you start to talk. And since you spent too much time for the first question, I'll ask you to be very short on the second one, so we can go through So 3 minutes for the second one. I'll be very up to the point in my question. So Anita, first, inflation headline core. Do you see the headline peaked, coming down now until the end of the year? And how sticky you see the core? What do you think you still need to do?
Okay, I must say that we are seeing some positive signals. The headline inflation peaked in October. Since then, it's on a downward trajectory. Core inflation stabilized at the beginning of this year, so with some lag. It's important that we see persistency in this trend. This stabilization in core inflation coincides with some easing on the inflationary expectations, at least from the survey that the European Commission does on a regular basis on the inflationary expectations. And plus, we are seeing declining share of components of, in CPI with high inflation. When I say high inflation, I mean above 10%. They have been declining already for 4 months. Mm-hmm. So there are some signs, no doubt, but I think prospectively the future inflationary dynamics in such countries such as ours will predominantly depend on 3 factors. First, persistence of global supply shocks. That is something beyond our control. Second, on our vulnerability to these shocks, which in essence boils down to the structural features, which cannot be changed overnight, but we have to change them, we have to work on this. And in this segment, we also see some positive signals in the energy sector, scaling up of the investments in the renewable energy, supported by significant credit growth, 75% increase of green finance in the last 2 years, which will ease at least pressures in the medium term. And last but not least, we have to maintain prudent macroeconomic policy mix, prudent monetary policy, but having in mind the type of the shocks, complicated set of shocks that we are facing, it's key that the monetary policy continues to be supported by the fiscal policy, especially to prevent wage growth setting at persistently high level, incompatible with the productivity growth and notion of medium-term price stability.
Excellent. Fatma, do you agree with that?
You know, we have to work on all different perspectives about the pricing. This year, we are expecting, we have slightly different projection for this year inflation, but in terms of the policies, we are still, as I mentioned at the beginning, in terms of policies keeping the consistency and the measures. I was just trying to look at the latest data on the revenue side. What happens on the revenue side as a reaction to the inflation this year. It has some leverage from that, which is not our main goal, but at the end of the day, what matters is to provide the financing, which is, now I'm talking from the budget point of view and the government policies, and I may say from today's perspective that the good thing now to turn on what we project and what Liliana said, certainty, the uncertainty is the certainty is we all prepared for a heavy winter in terms of the energy prices and this. This is something that gives us the leverage and room for both for monetary and for fiscal policy for this year. So we are just now on the coming out on the springtime in terms of costs. And I do hope, but the challenge remains because the economic activity is a bit lower than what we projected. And probably the expectations and what happened all this period has set a stake on economic activity, but for the rest of the year, we do expect that we'll have a better conditions and still keep to our initial projections.
Okay, thank you very much. Peter, you're the central bank that operates for many years with a negative equity. We're in a situation where there may be other central banks who will get into the situation of negative equity. There will be some for sure. So how is it to operate with a negative? Can the central bank do it? Are there any limitations? You feel any problems operating with a negative equity?
Of course, is it a pleasant question or not? I'm not sure.
No, it's a...
but it's a real...
people are wondering, you know.
Yeah, definitely. Yes, you can live with that because, my central bank had and has negative equity as a legacy issue that was a heritage coming from the process of adoption of euro. We just became the victim of our success because due to appreciation of our exchange rate. If you remember, that was miracle in that time, and we as a bank, we had to intervene many times. So that's the source of this losses in 2009 or 2008 in this time. So
you revalued 3 times.
Yes, exactly, and that's the price for that. That was a 4 billion. That time we replenished a lot, more than 50%. So so that was our distribution of profits over last more than 12 years. So it's doable. And what's the most important, that there's no burden, so no obstacles to the monetary policy. I think this is the crucial, because you can as a central bank, you can operate, you can pursue your mandate. I'm pretty sure about that. When I was finance minister, so I was really envied, so how come to earth, how it is possible, just that you can survive. And I remember, and here I have to warn, because finance ministers, because as a finance minister, I tried a little bit politely convince central bank distribute the profit, but the ECB backed our central bank. No, you have negative equity, so first of all you have to go back to positive equity, and then you can distribute the profit. But nowadays, the situation is coming. So there's one real disadvantage is there, because please, finance ministers, don't count on us anymore, because for a certain period of time we won't be able to distribute our profits as a central bank. So and the reason, I think, just to be explanation is quite simple why these losses are coming again. This is a dark side of crucial help we provided during the pandemic, during this time of high inflation. And it was necessary, and it was inevitable, I think. So, so we can weather these effects, and we will pursue our mandate.
You used your Ministry of Finance not to receive anything, so now it's like like the Israeli central bank.
In our case,
us who use them to get some money, we have problems now explaining why it's not coming. Okay, thank you very much. Raduje, in Montenegro, you're one of the few countries where the wages increase faster than inflation. Do you see that as a problem for inflation?
As I already mentioned, last year in Montenegro, our country was 17.2%. This year, in January, little bit less, 16. And in the short term, it produce some increased tax base, will be useful only in the short term. In the medium term, will be a big problem about widening some deficit and cost, how will funding in the future. The second problem is, I already mentioned, and again would be say to the public area about increased salaries. Salary increase without any increase in productivity or in creation new value, not widening economic basis, not new project and the others. Then social spending without any that analysis about really needs and implication on the budget. The other internal elements in our country is inadequate economic structure, mostly based on the services sector, tourism, transport and trade. We propose to the government to diversification our economy, much more finalization. We have a good example in our newest municipality, Tuzi, who established new factory with domestic products, and also a small and consequently open economy like our country, like our economy, much more will be hit by world crisis, pandemic. But in pandemic, we prepare 12 measures of packages giving support to citizens, companies, and the bank system also. But in the real economy, problem about competitiveness. Now, war in Ukraine, pressure on some pricing, food and energy and the others. I hope we need some support from IMF. It will be official request for CBCG. And we will see in the spring meeting in the near future in Washington about it. We need optimization, especially in the public area, and rationalization in the fiscal area in the process of increase sustainable fiscal policies.
Thank you. You're not the only one that needs that, but Liliana, how much the EIB can help the countries in the CEE region to become more resilient to the future supply side, particularly energy shocks?
Let me first say that in order for all of us to address the, let's say, to ensure resilience of the economy and to address any energy shock or energy shock, first we need to stay united, to align, to ensure complementarity of the funding. This is, I believe, critical. And this is what I can give just an example of how we see it. For example, Repower EU as a package of investment. What we have decided on EIB side is to complement by additional 30 billion to Repower EU package. So in the next 5 years to mobilize 120 billion of additional financing in support of the overall objective of, let's say, reaching net zero economy. Second message here, which I really have, we need to act forcefully, but at the same time, we should not shy away from the global competition, because every euro, dollar spent, US, Asia, in reaching the goal of net zero is welcome and should be welcome, and we should not be afraid of. But at the same time, we need a level playing field, and we need to make sure that in Europe we are complementing and we are united in establishing different new tools and instruments, which are extremely important. One of which is, for example, the new Pan-European Equity Fund. This is an opportunity to support large-scale investments, strategic investments in Europe, to focus on the direction of travel of net zero economy sooner or later. The other element is, of course, to diversify, to expand really the potential of our economies. Again, we do have the right instruments inside of the EU. This is the InvestEU with the different investment mechanisms, and for us as a key implementing partner is we do have the right firepower. We have the legacy of the Juncker plan, so we have the instruments in place. For outside of the EU, the new initiative called the Global Gateway is another how to say, approach to ensure that we have the right instruments channeled to that. And last but not least, we need, if we are to ensure resilience of the European economy, we need to be more mindful and actful, like supporting the venture capital market. This is critical. So the new European Tech Champions initiative, which was launched last year, strongly supported by us, is again based on our fund's extensive experience in supporting VC environment in Europe. This is where our resources will be channeled, because this is exactly what we need to promote. And we are also thinking on complementing so-called SKOPJE initiative, another new initiative, always with nice names and abbreviation, which stands behind the new investments in providing more scale-up funding, because these type of instruments are extremely important for our economy. And last but not least, we should be mindful nowadays in investing more in critical defense and security. This is another area of investment. So here the bank is also playing a role, but focusing not on weapons, not at all, not eligible, but dual-use infrastructure, technologies, R&D. So we have a new plan in support of strategic European security initiative, so-called SESI. Our plan is to mobilize 6 billion, which means about 1 billion per year in support of these dual-use technologies in infrastructure and technologies in the area. So good partnerships, keep unity, and act forcefully and allocating the right resources for high riskier and much quicker. This is what we need still in Europe, like lagging behind vis-a-vis our partners in US, in Asia.
Okay, so technology rather than tanks.
Yes.
Okay, excellent. Thank you very much, everyone, for this wonderful conversation. You see, you can do it in 3 minutes when you give an effort, and I think we're now having a coffee break. Thank you.